Welcome back to class. This is SFM. Specifically, we are still in investment appraisal. Our motive in today's class is to take several questions directly from ICANN past questions to cement our understanding. We have looked at part one of investment appraisal, of which we solved multiple questions. Today, I'll call it part two, which we're going to be solving other multiple but technical questions. And the first on my list is going to be should I call it a regular investment appraisal question with sensitivity analysis attached to it. So please be very, very careful as we go through this question. Please, May 2023, question 3. Please, I believe you are with your calculators. Oh. Okay. May 2023, question 3. Yeah. Let's see. Okay, this is it. Now, if you check the requirement of the question, they say evaluate the proposed expansion from a financial perspective, 10 marks. Evaluate the above expansion from a financial perspective, 10 marks. In case you have an issue with interpreting the requirement of the question, this one, when you hear the word evaluate the proposed expansion, you should know this is an investment appraiser question. Even without you reading this, you should know that this is an investment appraiser question. Another thing that is similar to it is maybe mergers and acquisition. But when you now come to the body of the question and you begin to see some variables, you know, this is an investment appraiser question. And I've told you by default, when ICANN tells you to appraise an investment and they did not specify the method to use, okay, there's a 95% chance that that particular question is an NPV. There's no two way around it. At least at SFM level, there's a 95% chance that that question is an NPV question. If it is any other question, they will specify maybe using ARR or they will specify. But when they just say evaluate an investment and they are silent, okay, it is NPV. And checking the makeup of the question, you should also know this is an NPV question. It's a short question, but let's see what we can do. Atinco Limited is considering an expansion project. The project will involve the acquisition of an automated production machine costing 11 million. Now, this 11 million is your capital outlay, isn't it? Your capital outlay. That is the amount that you are investing in a project, okay? And it forms an outflow. And payable now. When they say payable now, it simply means that you are investing that money now. And that now, yes, simply means what? Year zero, isn't it? I've taught you that. So year zero. Okay? The machine is expected to have a disposal value at the end of 5 years, which is equal to 10% of the initial expenditure. So you're going to do 10% of 11 million to get your scrap value. And don't forget, your scrap value is an inflow. Am I making sense now? All right, that makes sense. The following schedules reflect a recent market survey regarding the estimated annual sales revenue from the expansion project over the project's 5 years life. There's a level of demand. If demand is high, we're expecting that sales will be what, 16 million, all right? But the probability of that 16 million happening is only 25%. If the sales is medium, what we should be expecting from sales is 12 million. The probability of sales being at medium is only 50%. And if the sales is low at all, we're expecting 8 million. But the probability of it being 8 million is 25%. All the probability must be equal to 100% or 1. Okay? All the probability must be equal to 100% or 1. So if you add this up, it should give you 1. Am I making sense now? So we don't really know. This particular thing here, this thing that the ICANN included here is risk and uncertainty. Let's just put it as uncertainty. Uncertainty. Okay? ICANN is merging uncertainty with investment appraiser. All right? So that is what it means. Now, we don't really know what our sales would be. The economy is dwindling. We don't really know what tomorrow holds. But what our analysts can give to us is that, look, if everything goes well, which is high, if it goes very, very well, we should be expecting to sell 16 million. But we are not too sure if it will go well. But we have a probability that we can attach to it, which is just 25%. So there's a 25% probability that everything will go well. If everything does not really go well, let's say at medium, we have 50% for that probability of that, and that will give us 12 million. And if everything goes bad, like if it doesn't go the way we are expecting it, our sales is going to be 8 million, and the probability is what? 0.25%. So as I've said, all the probability must be equal to 1. Now, the challenge that people usually have here is, what do they do with this kind of information? What do they do with this kind of uncertainty information? When uncertainty is given to you, I repeat, when uncertainty information is given to you, please look for the average. So we're going to be looking for the average of this information provided to us. It's as simple as that. No two way around it, okay? Even a newborn baby knows that one. Now, it is expected that the contribution to sales ratio be 50%. Now, that word is contribution to sales ratio. If you are my PM student, this word should not be anything before your ears, okay? Contribution to sales ratio is 50%. It therefore means that inside sales, look at my English, inside sales, comma, contribution is what? 50%. So if your sales is 10 million naira, okay, how much is contribution inside? Contribution inside, let us assume 50% will be what? 5 million naira. And so if contribution is 5 million naira, it therefore means that variable cost is 5 million. Am I making sense now? If contribution is 5 million, it therefore means that variable cost is what? Is 5 million, because the definition. Please, who is that now? Are you talking to me? Because the definition of contribution is what? Sales minus variable cost. So if contribution is 50%, which is 5 million, it therefore means that invariably variable cost is what? 5 million. Therefore, sales minus variable cost equals to what? Your contribution of 5 million. That is what ICANN is trying to tell you here. That even as you have gotten your sales from this information, because this is the information you use in getting your sales, your average sales. Inside the sales, this is what you are expecting as contribution. Now, additional expenditure on fixed overhead is expected to be 1.8 million per annum. You're going to incur a fixed overhead cost, which is equals to 1.8 million naira every year. And that makes sense. Now, come down, they say that TL incurs 20% tax rate on corporate profit. TL incurs 20% tax rate on corporate profit. This is not the first time I'm telling you. Even if ICANN did not put on corporate profit, your brain should tell you that taxes are always calculated on profit, not on cash flow. But your MPV is calculated based on what? Cash flow. But let your profit be calculated based on what? Profit. Now, they said corporate profit is paid 1 year in arrears. It's normal. Even in your taxation class, you know. 2020 will be paid in 2021. 2021 will be paid in 2022. So there's a delay. And I've told you the implication of delay in tax payment. I told you that if a project will last for 4 years, if there's a delay, like paid in arrears, it therefore means that that project will automatically be for what? 5 years. It's as simple as that. All those ones should be at the back of your mind already. They now went further to say that TL's after tax nominal. Now, ICANN is very linear. They put money here. If it's me that said this question, I will not put money, because I will not put money here. Let me deceive people. So the after tax nominal discount rate is 15.5% per annum. The word nominal is money. Okay, so the money rate of return is 15.5 per annum as the money rate of return. That's it as nominal rate of return or nominal discount rate or money discount rate. Any how they want to put it, the same thing. So in case I did not put in bracket money the next time, note that nominal discount rate is the same thing as what? Money discount rate. This is the discount rate that inflation has been factored inside of it. Don't forget. Now, a uniform inflation rate of 5% per annum will apply to all costs and revenues during the life of the project. Now, when I was talking about investment appraisal, I mentioned inflation. Does anybody know the type of inflation I mentioned? I mentioned inflation. Does anybody remember the type of inflation I mentioned? Please, quickly. Anybody? Do you remember the 2 types of inflation? The 2 types of inflation.
Real inflation.
Specific and general inflation.
Thank you. General and specific. As me, you don't know this, I would have just ended this class. It's not you people who do me. Thank God you don't know my house. Okay. General and specific inflation. Based on what is stated there, is it specific inflation or general inflation? A uniform inflation rate of 5% per annum will apply to all costs and revenue during the life of the project. Is it specific or general, please?
General.
General. Thank you. All right. Specific simply means that individual items will have their own attributable words, inflation rate. For this one, everything, both the cost and revenue, everything is inflated by 5%. So it's a general inflation. And they say that all the values above have been expressed in terms of current price. It simply means that all the value you are seeing here, 16, 12, 8, all the money that you have been seeing that have been given to you in this question, they are all expressed in terms of today, which is what? Year 0. It simply means that the values in this question are at real cash flows. But the discount rate given to us is at what? Money cash flow and money discount rate. You understand what I mean by that? All the cash flows, all the money given to us here, they are all real cash flow, meaning that, which is year zero. But, okay, the discount rate given to us, which they say the after-tax nominal discount rate, is at what? It's at money discount rate. And I've given you the rule. If you are giving real cash flow and you are giving money discount rate, both of them must marry. You cannot use your money discount rate on real cash flow. Please go and watch my part 1. It is very, very important if you have not watched it. You must use money discount rate on money cash flow, and you will use real discount rate on real cash flow. So in this particular case, 2 things are involved. Since they have given us money discount rate and they have given us real cash flows, we can decide to convert all the cash flows to money cash flow. So we'll use those figures against our what? Money discount rate. Or you convert your money discount rate to real discount rate and use that discount rate directly on the figures given to you in the question. Any one of them will work. Am I making sense? All right, so you can assume that all cash flows occur at the end of the year and that the initial investment does not qualify for capital allowance. We have solved the question before where I told us that the investment does not qualify for capital allowance. What does that mean? It means that there has been nothing like what? Capital allowance computation, or what we call depreciation computation in the question. There'll be nothing like that. It therefore means that your cash flow is the same thing as your profit, because the difference between your cash flow and your profit was the capital allowance, which is the depreciation. But since there's no depreciation, your cash flow and your profit are the same thing. Does that make sense now? Secondly, they said that it is assumed that all cash flows occur at the end of the year. That is the primary assumption. That is the default assumption for investment appraiser. All cash flows are assumed to be at the end of the year. It therefore means that any cash flow at the beginning of the year will be attributable to the previous year. Before. If you are told that you received money as at the beginning of 2020, what did I tell you? Which year did I tell you that that money will go to? Anybody? You received money at the beginning of 2020. Which year will it go to?
2019.
2019.
Good. 2019. Good. When you receive money at the beginning of the year, it is attributable to the previous year. But when you receive money at the end of that year, it is attributable to that year. What about if you receive money at the middle of the year? Does anybody know about that? Nobody will tell you that it is received at the middle of the year, but in case they tell you it is received at the middle of the year or during the year, please, you are going to assume that it was received at the end of that year. So when they say middle or during the year, assume it is received as at the end of the year. But when they say at the beginning, that one has special treatment to the previous year. Am I making sense now? Am I communicating, please? Am I communicating, please?
You are.
Okay. Yes, the voice is not skipping today. All right, let's do justice. So the first one says, evaluate the proposed expansion from a financial perspective. Tinko, I think that's the guy's name. Tinko Limited. If I say this question in exam, it's 5 minutes. Please, how many years is this project? Who can tell me? How many years is this project? 5 years. 5 years. It means that when I was talking, nobody was even jotting salient points. They're just looking at the screen. 5 years. So let's go. Let's start from year 1. Okay. Year 1, year 2, year 3, year 4, year 5, year 6. Oh, I've made a mistake. Why did I include year 6? Is year 6 supposed to be here?
Yes.
Why?
Because of the arrears.
Because of the arrears in taxation. Thank you. Since I did not include year 0 here, is that a problem? Should we be worried about not including year 0? No. Thank you.
It's not a problem.
No, these are what I want to hear. It's not a problem. Thank you. If you see investment appraisal in your exam, is that a problem?
No, sir, it's not a problem.
It's not a problem. Thank you. It's not
a problem.
Thank you. So let's solve this one now. So as I've told you, investment appraisal is all about inflows and outflows. I've told you. There is no special format that was brought by one professor or by one legend or by one scholar that it must follow this pattern. If there is, I am not aware of it. please let me know. I have not seen a standard format for it. Okay, and we just use our head, sometimes professionalism. So what we are trying to look at is inflows minus what? Outflows. And once we do that, we'll get our net cash flows. Once we get our net cash flows, we now multiply it by discount factor, and that is all. So what are the inflows in this question? The inflow in this question is specifically what? Sales. The following schedule reflects the recent market survey regarding the estimated annual sales revenue from the expansion project over the project 5-year life. So what I can see here is that they're talking about sales. And to me, as an accountant, I know that sales is revenue. But the problem I have in this question is that they did not tell me the exact sales. They were giving me probability for the sales. And what did I say? If you are giving probability for sales or if you are giving uncertainty, what did I say? What is our judgment?
You had everything and get the average.
It's not me and you. I say you get the average. Where are you at? You get the average, Abby. So let's do A. Let's get our average sales. Getting our average sales is as simple as dotting your I's. Okay? So we have high, we have medium, and what do we have again? Low. So here is 16 million, Abby. Here is how much? 12 million. And here is 8 million. I'm not fabricating the figures, so look at them here. They are all here. Then this is our probability, Abby. 0.25. Oh, yeah, somebody should multiply. Then here is 0.5. Somebody should multiply. How much, sir?
4,000 for high.
4,000.
6,000 for medium.
For medium.
And 2,000 for low.
I already know who is talking. I already know who is talking. Add up for me.
12,000.
Okay. If you add up this one, did you get one?
Yes, sir.
Okay. It therefore means that our sales that we'll be making use of is what? 12,000. 12 million. You know, it's in millions, so it's 12 million. Any challenge? Any challenge? All right.
No, Bob.
The next thing I want to calculate is contribution. Contribution. We are told in the question that out of our sales, how much is contribution? Out of our sales, how much is contribution?
50%.
50%. So do 50%. 6,000. Are we good now? So in my solution here, advise me, should I go and put sales there or should I go and put contribution there? Which one should I go and put there, and tell me why? Should I go and put sales in my solution of 12 million or should I go and put contribution? Tell me why.
Contribution.
Contribution.
Contribution. Why are we going with contribution? Why not sales? Anybody?
Or sales minus variable cost will give us contribution.
Okay. So rather than coming here and saying sales and put variable cost to come and get contribution, why don't we work smart by eliminating these two and just going with contribution? After all, it's contribution that is the main thing. Are you getting it now? So why not eliminate the sales and variable costs and just work with contribution directly? So that is how you work smart. So I'll work with contribution. But I have to be very careful, okay? I have to be very careful. Why must I be careful? We were told in the question that all the values above have been expressed in terms of current price. And what did I tell you is current price? Yes, 0. It therefore means that, it therefore means that this value that we got here is here 0 because we got them from current prices. So what do we have to do? We have to get figures for year 1, get figures for year 2, for year 3, for year 4, and year 5. And the only way we can do that is by applying our inflation factor. How much is it? 5%. Where is that guy? I saw it somewhere. Okay, look at it. Inflation rates of 5% per annum. So if our contribution is 6,000 naira as at year 0, what do you think our contribution will be as at year 1? Anybody? What will it be as at year 2?
Is there under the 15.5%?
105% of 6 million.
Okay, hold on. I think we can do better. Let's do better. So let's do better. We were expressly told that there's a fixed cost here. Look at the fixed cost. It is expected that the contribution to sales ratio is 50%. Additional expenditure on fixed overhead is expected to be 1.8. Can you hear me? Can you hear me, please?
Can hear you, yes, we can hear you.
Okay. So I said, let us do better. We were expressly told that fixed cost is 1.8 million. You already know that sales minus variable cost equals to contribution. The contribution minus fixed cost equals to what? Cash flow, Abi. The cash flow minus depreciation equals to net profits. So, but what we need for the purpose of investment appraisal, NPV, is cash flow. So since we already have our contribution, which is what? 6,000 naira. Don't you think it is wise for us to just remove fixed costs? How much is fixed cost? 1,800. After inside, there's no depreciation inside the fixed cost. Okay, in some cases, they'll tell that depreciation is inside the fixed cost. But in this case, there's nothing like depreciation inside the fixed cost. We are not told. So this fixed cost is fixed cost, excluding depreciation. It therefore means that 6,000 minus 1,800 will be equals to what? 42, Abi? 42. So this 42 is our cash flow. So let's work with this figure by inflating it by 5%. Are we together? Are we together? Are we good? Talk now. Is anything confusing? I have crowd here. Who is talking? Who is not talking? Let me know. Should I proceed? Can you hear me, please? Can you hear me now, please?
Yes, sir. Yes, sir.
Okay. The point where I got to this 4,200, was it clear? The point I got to 4,200, was it clear?
Yes, yes, it was.
Okay, so let's work with that rather than working like an amateur. Okay, let's work with that. All right, so 42. So let's get the figure. This 42 is at what? Current, Abi, which is year 0. So let's get figure for year 1, year 2, year 3, year 4, and year 5. So increase 42 by 5%. What are we getting? Increase it by 5% because of the
4,410.
Let's put it direct. So let's call it cash profits. What you call cash flow, cash profits. So can call it cash profit. 4,000 what? 410. Next, increase this 4,410 by 5%. 4,410 by 5%, please.
4,631.
4,631, Abi?
Yes.
Increase by 5%.
4862.
4862.
4862.
5105.
5105.
5360.
5360. All right. Don't go and do for year 6. So the project is 5 years.
Hello, boss.
Yes, sir, I'm with you. Can you hear me? I think we lost you. All right. Any question before I proceed, please? Any question? Any question before I proceed?
Hello, boss.
Yes, sir, please. We can hear you.
Please, can you hear me, sir?
Yes, sir, I can hear you. Yes, sir, you can proceed. I don't think.
Where is the inflation rate? Where is the inflation rate given the question?
Where is the inflation rate given to the question in the question? This is it. Check my mouse. That's it. Any other question?
Is it 50%?
5%. Look at my mouse, please.
Okay, 5%. Okay, thank you.
Any other question, please? Okay, fine. In summary, what we have done is that we have done sales, we have done variable costs, we've gotten contribution, we have less fixed costs, and we have gotten cash profits. These are everything that we would have put on this table now. But because we are smart, we have to convert everything. We did it as working and got one figure. Okay, so there's nothing again in this question. If you check, there's nothing again in this question. Let's check together. Let's check together. There's nothing again that we have not done, apart from, let's say, tax. So let's check together, so we can be on the same page. Okay. All right, so let's check. Let's check. Have we used all these figures to calculate our sales? Yes or no? Oh, yeah, now.
Yes.
Good.
Yes.
Yeah. Have we used this 11 million is our year zero? Okay, no shaking. Then 10% of our 11 million is our scrap value, and that will be tax. We have to put tax first before we put scrap value. Okay, good. Let's see whether there's any major thing. 50% contribution, have we not used it? We have.
We have.
1.8, have we not used it? Fixed costs.
We have.
Good. So now let's calculate our tax first. Then after our tax, we'll now include our scrap value. I've given you this before. You calculate your tax before you put your scrap value. Okay? So how do we compute our tax? How do we compute our tax, please? How many percent is tax, Seth?
20%.
20%.
I'm going to look for it. Okay, 20%. So our tax is 20%. So where are we putting our tax on?
Second year.
Second year.
Year one. Year
20%
one
of what?
tax will be in year 2.
20% of what? Are we doing it on these figures?
Yes.
Net profit.
Wait. Are we doing 20% on these figures? Yes or no?
Yes, now.
Why?
Well, this is actually supposed to be on profit,
Well,
not
profits now.
cash
Because
flow.
it
This
is
is cash
it is
flow.
calculated on cash flow.
Eh?
The tax is calculated on cash flow.
Tax is calculated on cash flow.
Tax is calculation on profit, not
Tax
cash
is
flow.
calculated on profit.
Profit.
Okay. So tax is calculated on net profit. Okay. So how do we get our net profit? Cash flow, minus depreciation, isn't it? That's how you get your net profit.
Yes, sir.
Do we have depreciation in the question? Do we have depreciation in this question?
No.
Good.
No depreciation.
Thank you. The answer is no. There is no depreciation in this question. There was a place they told us that there is no capital allowance. I'm trying to look for that place in case you see it before me. They told us that there's nothing like capital allowance. Look at it.
The last paragraph,
Initial investment does not qualify for capital allowance. I guess it now. So there's no depreciation. So since there's no depreciation, that means depreciation is zero. Now, anytime that depreciation is zero or there's no depreciation, it therefore means that net profit and cash flow are the same. Do you agree with me?
Yes, sir.
Good. It therefore means that these figures you are seeing here, that I call cash flow or cash profit, invariably they are still net profit. And the only reason why they are still net profit is because depreciation is not given in the question. That means I can apply my 20% of those figures directly without shaking. Are we good? Are we good?
Yeah, yes, we are.
Oh yeah, let's go. 20% of 4410, how much? 882.
882.
20% of 4631.
926.
20% of
926.
973.
Next one.
926.
107.
Which one is 107? For year
No,
five?
the last one is 107. 6. Yes, 6 is 107.
Okay, I'm coming. That person with TV, you can help us. 5360 is okay, 107.
Yes.
536.
The other one is 102.
I'm getting 107 too.
102.
I'm getting 1021.
Yes, 1021.
All right, so is anybody confused why I jumped year 1 and moved to year 2? Is anybody confused? You people don't know. You people don't know what is before you. That is why you are delaying me. You are delaying me. You don't know what is before you. We've not even started. Are you confused why we delay? We move it from year 1 to year 2? Yes
No,
or
sir.
No.
You are not confused. No.
No.
All right. Since you are not confused, therefore means that you are understanding. So what's the next thing? Scrap value, Abby. Please, what is our scrap value? What is our scrap value? Our scrap value is 10% of what? 11 million. So let's go. Number C, scrap value is equals to what? 10% of 11 million. And what is 10%?
1,100.
1,001. That is 1,100,000.
Yes, sir.
Yes, sir.
One is 1,001. Okay. These people will not kill. Okay. 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 Before I do any other thing on this scrap value, I want to ask. These values we are now getting here. Who can tell me what kind of values are they? Is it real cash flows or money cash flow?
Money cash flow.
Why?
They are no
Because
longer current fair value. Inflation has been
taken
used.
place.
Inflation has been added to it, Abby.
Yes, sir.
Yeah.
Okay, good. Now, this 11 million that we have here that we bought the asset, is it real cash flow or money cash flow?
Real cash flow,
Why is it real cash flow?
because it is the value as at today,
God will bless
as at year 0.
As at year 0. It was stated in the question, Abby. As at year 0. There's a part they stated it. Okay. Or at current prices. This is the part that they stated it. Good. Now that we use that 11 million, we said 10% of the 11 million. This 1,100 that we got, is it real cash flow or money cash flow?
This is real cash flow based on its current year value.
Good. Because this 11 million is real cash flow.
Yes.
What to SFM student? Because this 11 listen, this 11 million is real cash flow. Abi. We use 10%, what do you call it? Our scrap value is 10% of this 11 million. It therefore means that this answer that we still got will still be in real cash flow. But when are we going to sell? When will this scrap value be effective? When are we selling?
At the end of 5 years.
God will bless you at year 5.
At the end of the year.
Thank you very much. At the end of year 5. So if this 11 million is at year 0 and we are selling at year 5, don't you think that we should inflate this 1.1 million by the inflation rate of 5% for 5 years?
Yes, we should, sir.
We should, Abi. Thank you.
Yes, sir.
So that means that our scrap value will not be 1.1 million again. because we are not selling now, which is year 0. We are selling in 5 years' time. What would that be? 1.1 million times what? Into bracket 1, Abi, plus what's our inflation rate? 0.05. Abi, close bracket, raised to power 5. That's how you would do it. So do it 1 plus 0.05 raised to power 5. This is your discount factor. This is your I'm not calling discount factor, compound factor. You are compounding.
No.
What are you going to get?
1,403,909.
40. That is 404, Abi, approximately.
Yes, yes.
So this 1,404,004 is our scrap value at year 5, which is the year that we are selling. Anytime you want to inflate a figure, you understand? Then you want, like today, now they tell that the money is 5,000, and you want to get it. How much will the money will be in the next 10 years, 15 years, 20 years, 30 years, 7 years? Just say that 5,000, I get it now, times into bracket 1 plus what the inflation rate would be. If the inflation rate is 10%, it will be 0.1. And if you want to get it for 20 years, you say it's per 20. So this is the formula that you will use. This is the way you will do it if you want to get a future amount, a future value. You understand? So this is like compounding future value. Am I making sense? So I'm going to take that 1,404 and put it in year 5. So I'm going to call it scrap value. Here will be dash, 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 1,404. Please, is it going to be a positive or negative value?
Positive. This is an inflow.
Yeah, thank you.
Positive.
So we are done. No, we are done. Give me a figure. So this is our net cash flow. We are done. Give me a figure. You'll see before 4.
Year 2 is 3749.
3749. Year 3.
Year 3 is 3936.
3936. Year 4.
Year 4 4133.
4133.
4133.
Year 5.
Year 5 5749.
So this is our net cash flow. In this question, is there okay, we are done. Our net cash flow. So our discount factor. So since all these cash flows are now in money terms, Abi, they are now money cash flow. Therefore, it means that we can now use our rate 15.5% to discount, Abi. So our discount factor at what? 15.5%. The formula you are using is 1 all over 1 plus R raised to power n. So somebody should take year 1, somebody should take year, just split it. Somebody should do from year 5, somebody should do year 6. What would the discount factor be at 15.5%, please?
Year 1 is 0.8658.
866. Just give me 3 decimal.
Okay, 866.
You can multiply direct, so we'll not be coming back. You can multiply to get our present value.
Year 2 is 0.749. Year 3 is 0.649. Year 4 is 0.562. Year 5 is 0.487.
Year 6.
Year 6 is 0.421.
The rest, what have you been doing?
Year 1 3,000. 19.
It's not me and you.
How not multiplying it?
Multiply it. Let me see.
381.
Sorry, 3819.
You see, and you wanted to challenge me.
I'm not wearing my glasses. I'm sorry.
Yeah,
19.
brother. Hope you carry your glasses to the exam or you will not forget.
I'll
Yes,
be fine.
two.
I've forgotten it before.
Uh,
2808.
and you passed.
2808.
2808. Second
Yes,
one, Abi.
2,554.
2808.
Mm.
2554.
554.
Yeah, 4.
2323.
2323.
Somebody should be adding them now. Somebody that is there should just be adding from year 1, be adding everything and becoming. Oh, yeah, year 5.
2,800.
Yeah, 6. 4.
Who is that?
If I arrest that person.
Hello, sir. Hello, sir.
Yes.
Who is that one?
Yeah, 6. 451.
All right. So since you have our present value, can somebody give me my total present value? Add everything for me. Can you hear me? Total present value, add up everything. Minus this 451.
13853.
13853. Let a student tell me what is the next thing for me to do. One person, just tell me what is next for me to do. What is next? When you people will not read. Initial outlay. That's the year 0. Abi? That's your year 0. How much is that? 11 million. So that will give us how much?
Hello, sir.
Yes, sir.
Sorry, sir. This present value, I don't know if somebody else can also confirm. I'm getting about 14,000, and like I've done it twice.
This person that got 13,853 alpha.
It's correct. It's
I
correct.
got a 13853 too.
Okay,
It's correct.
So let's go with that. Let's go with that. I'm so sorry, madam. We have to go with them. So what is our MPV?
So 2,853.
2853.
Any question?
So maybe that lady should know that that 451 is negative, not positive.
Okay, it's true. I have over how many persons here? The rest, they're just looking at us morose. No problem. What's the next part of this question? Calculate and interpret the sensitivity of the project to changes in expected annual contribution and the tax rates. Now, this will now lead us to what we call risk and uncertainty. Risk and uncertainty. Now, under risk and uncertainty, we have several things to discuss, right? Risk and uncertainty is a very broad topic where we have expected value, sometimes we have simulation there, we have sensitivity analysis there, we have a lot. But specifically, I'm just going to be turning my energy to sensitivity analysis for tonight's class. Why? Many of your MPV questions usually come with sensitivity analysis. Even when I am modeling in real life, whenever we finish modeling for organizations or model for people that need it, we usually put a sensitivity model attached to it in case there's any changes in variable. How will it look like? That's what it means. So I'm going to explain. So specifically, I am. My voice is not fluctuating. My voice is not fluctuating.
So it is so.
It's your network. So specifically, I'm looking at sensitivity analysis.
Sorry, your voice is not quite clear.
Can you hear me now, sir?
Well, not with one sentence. Maybe if you run a couple of sentences, we will be able to tell.
Okay. Can you hear me now?
Very loud and clear.
Okay, thank you,
Thank
sir.
you.
So, all right, so let's look at sensitivity analysis quickly. Sensitivity analysis. All right. Why is it like, okay, good. All right. Now, quickly, I'll just tell you what sensitivity analysis is, what we use it for, and then I'm going to give you the formulas that you need to calculate for sensitivity analysis. Now, when we do MPV, right, like in this case, we have done our MPV, and our MPV is 2853. Now, once we do our MPV, which is 2853, and you present this to management, management is going to ask you some questions. Because first and foremost, you must understand that this thing is a futuristic thing. That's why they call it capital appraiser, investment appraiser. It's happening. All these figures you are seeing, we have not gotten to the third year. They are still in year 0. So year 1, year 2, year 3, year 4, year 5, and even the case in year 6 are all futuristic values. And these futuristic values, they are uncertain. So we call it risk and uncertainty. They are uncertain. Why are they uncertain? They are guesswork. It may not even happen in real life. Those figures may not even happen in reality. Who knows? Who even knows? This asset of 20%, it may not even be 20% in year 4. Maybe Tinubu would have come into power by that year 4 and say that the tax rate is not at 5%. So all these things are just based on the fact that we have now. So what top management wants to know is simple. They will ask you as the analyst, what about if this variable change? If this variable changes, how good or how bad will it affect our MPV? Let's assume that our cash flow, you said we're going to get cash flow of 4,410. And the reason why we're getting this 4,410 was because inflation rate was 5%. What about if the inflation rate was not actually 5%? What about if it was 2%? What about if it was 7%? How will our MPV behave? So the word sensitivity talks about how sensitive would be your MPV if the variables that were used to compute the MPV actually change. It's as simple as that, no big deal. That makes sense now. So what would you have done differently? How would our MPV look like if the variables that have been used to compute it, if they actually changed? So if our strike value actually changed, how would our MPV be? If our discount factor or discount rate changed, how would our MPV be? If our contribution, which we use in calculating this question, change, how will our MPV be? Those are the questions that senior managers want to know. Okay, those are the questions that they want to know. So that is why we call it sensitivity analysis. Now, for you to calculate sensitivity analysis, the formula is very simple and straightforward. Even a newborn baby knows it. The formula is simply, so yeah, this is sensitivity of cost of machine. They should have given us the formula somewhere here. Okay, this is it. So let's just say MPV all over what? The variable. That's how it is. Times 100 over 1. So this MPV is what you have calculated here, 2853. That's the MPV. The variable is that thing that managers are looking at and asking, what about if it changes? So the variable can be anything. The variable can be fixed costs in the question. The variable can be sales in the question. The variable can be contribution in the question. The variable can be tax rate in the question. The variable can be scrap value. The variable can be anything at all that makes up your computation. In as much as managers wants to know whether it is going to be good or bad, they want to know if that thing changes, how is it going to affect your MPV? Just simply say your MPV divided by that thing that managers are looking for or they are looking at, then times 100 over 1. But please note that the variable must be the present value. Okay, must be the present value because we're looking at MPV. So the denominator must be the present value of that variable we are talking about. So in this case, it therefore means that if we are looking at the sensitivity of the cost of the machine, in case they ask you, what is the sensitivity of the cost of the machine? You know, the cost of the machine would be 11 million in this case, in our case. So what is the sensitivity of what? This 11 million to 2853. What it simply means in English language is that What about if our initial outlay is not 11 million? How is it going to affect our NPV? What about if it goes up? What about if it comes down? Our NPV, that's what it means. So the formula to calculate that is simply say, put your what cost of investment or your NPV up. In this case, this 785 is their own NPV. Are you seeing it? Why? Look at the 3750 is their own cost of machine. So when they divided and multiplied by 100, they got 20.1 and 20.9%. Now, for every sensitivity that you calculate, you must interpret whether you are told or not. You must interpret whether you are told or not. If you like, don't interpret, you're on your own. Now, let's interpret the sensitivity of the cost of machine. Now, this means that the cost of machine can rise by a maximum of 20.9% if negative NPV is to be avoided. Now, let me show you my signature way of interpreting NPV. Because the things that makes up your NPV calculation, right, is inflow and outflow. Everything that makes up this calculation here, they are all inflows and outflows. So whenever ICANN says calculate the sensitivity of something, of any of the variables, that variable that they are pointing at can either be an inflow or outflow. If it is tax, it is an outflow. If it is contribution, it's an inflow. Am I making sense now? If it's initial outlay, it's an outflow. So no matter what they want to point, that thing that they are pointing on the table must either be related to inflow or outflow. So this is how I interpret it. If it is an inflow and if it is an outflow, the interpretation is different. So let's start with outflow because what we are looking here, cost of machine is an outflow. If it's an outflow, you will use the word rise or above. So therefore, you will say something like this. Since we got 20.9%, ignore what you see here. You will just say that the cost of machine, okay, the cost of machine should not rise above 20.9% unless the NPV will be what? Will be zero or will be what? Will be negative. That's what it means. The NPV will be negative. That's just it. The NPV will be negative. Now, why am I using the word rise? It's an outflow. It's a cost. Nobody wants cost to rise. So therefore, whenever we are interpreting an NPV that is a cost or that is an outflow, we usually use the word rise. We usually tell management that, look, this is a cost. We don't want it to rise. So this rate that we computed simply means that the cost should not rise above this rate. If we do 120.9% of this 3750, please do it for me. 120.9% of 3750. Please do it for me. You get 45.
Yes.
You got
453. 37. Yes.
It is 120.9 times what? 3750 divided by 100. Please do it again. Do it again. Please do it again for me. 120.9 times 3750 divided by 100.
4533.
4533. It's 34.
0.75. Yes, 34.
0.75.
Okay.
Yes,
Can you see
34
now?
exactly.
Good. Our cost of machine is now 4534, which is very close to 4535. Are you seeing it? Can you see what I'm doing? Which is very close to your 4535. I believe there's an approximation here. That is why this one is even surviving it. On a normal day, this cost of machine should have been more than this one, even if it's by 1, to pull this one to 0 or negative, any of it. So what we are trying to say that this 3750, if it rises by 20.9, that's why I say 120.9. If it rises by 20.9, it will force your NPV to be negative or even 0. That is the meaning of this sensitivity analysis. So let us interpret. The sensitivity of cost of the machine to the NPV simply means that with what we have computed, the cost of the machine, which is 3,750, must not rise above 20.9%. If it goes above it, imagine that it goes like 21% or 22%. Okay, this your NPV here will come to 0 or will come to minus. It's minus. it will come to minus, it will be negative. Negative. That's what it means. Are we good now? Are we good to go? Are we good to go?
Yes, sir.
Good. So there are formulas. So the same thing, look at this one. Sensitivity to product selling price. Okay? Sensitivity of the product selling price. You would just say the NPV divided by the present value of sales. So what is their NPV here? 785, which in the question is 785. Look at it here. Then what is their present value of sales? Their present value of sales is 16,195. That's why you have 16,195 here. FM students, are you with me? Please note that they put 16,195 here because in this computation, there is no tax. Listen to me, ICANN will never give you this one that they will not give you as simple as this. So in many of your questions, you will see tax. So when there is tax, you have to tax this figure because this is an inflow and this inflow will be subject to tax. So this present value of sales, okay, this sales will be subject to tax. If it's contribution, so it's the same thing, contribution will be subject to tax. So majority of your inflows are all subjected to tax. What you would have done is to say 16,195, you do what? You apply tax on it to take away the tax. It's the remainder that you need here. So please take note of that. When you start solving your past question directly, you will see it there. It's plenty inside your past question. I think it's even what you want to solve now. So the next formula is what? Sensitivity to sales volume in units. Okay? Sensitivity to what? Sales volume in units. You know, volume in units talks about the quantity that you want to sell or the quantity that you are producing. We talk about purchase units. So in sales volume in units, talking about the quantity that you want to sell. So because that quantity, okay, that quantity, we cannot make use of the quantity. Imagine that they told us that the quantity is 5,000 units that we are selling, or it's going to be 6,000 units that we are selling. We are not going to make use of that quantity when we are calculating our sensitivity analysis. What we're going to make use of is our variable costs, because our variable cost is seen to move in line with quantity. So the best thing for us to do is to what? Is to use our variable cost for it. Please, I know why I am putting my mind to tell you this. Please, the formula is NPV divided by the present value of the total variable cost. Although the name is sales volume, but the denominator is variable cost because variable cost is seen as a direct substitute of the sales volume. It moves as the volume of sales is moving. So we are using our variable cost here. Please take note of that. Am I making sense now? Okay. Then the next one is what? Unit variable cost, sensitivity of our unit variable cost. Now, if you check it very well, it is similar. Okay, it is similar. Okay, it is very similar, but there's a difference. Okay, so unit variable cost. What's the formula? NPV all over what? Present value of total variable cost. Who can tell me the difference between this and this? Did we check this one? 785. Hold on. 785. Okay, what's the down one? It's the present value of total variable costs. So what's our total variable cost? 9717. Did they use that? No. What did they use? They use contribution. Thank you. So 6478. 6478. So the difference between it is that this will be using contribution, while this will be using the variable cost directly. Am I making sense now? So this sales volume, the formula will be NPV over contribution. So contribution is what? Selling price minus variable costs. So this sales volume is a function of both the selling price and the variable cost. That is what it means. So please bear that in mind. Bear that in mind, please. Bear that in mind. The one that usually, okay, let's look at fixed cost. NPV all over the present value of fixed cost. So 1943. Just go and check your fixed cost there. Look at it here. 1943. That's the figure that they will use. The other I talk about here among all these things is your IRR, which is your cost of capital. Okay, whenever I can tell you to calculate the sensitivity of your cost of capital, you will need to calculate your IRR. Okay, your IRR is your break-even cost of capital. I hope you know that. Your break-even cost of capital. The cost of capital that makes your inflow to be equal to your outflow. So you need to calculate your IRR. They will not give you the IRR. You have to go and calculate it by yourself. So once you get your IRR, you are going to subtract the cost of capital from it and then divide it by your cost of capital times 100. This is the only formula that looks different from our conventional formula, which is your NPV divided by the variable. This one is different. So this one is usually stands out. And I can usually attach more mark to this and more mark to what? Life of the project. When you're calculating the sensitivity of the life of the project. Okay, simply means that what about if the project extends? What about if the project reduces? Okay, you say 5 years. What about if we spend 7 years later on? Or what about if we spend 3 years later on? What is going to be the effect? Whenever you are calculating the sensitivity of the life of the project, what you are using is your discounted payback period. And this is how it is calculated. It's very simple. Okay, this is how it is calculated. So let me tell you how discounted payback period is calculated before we solve our sensitivity analysis question. Just put your years. It's the same way we usually calculate our payback period of uneven cash flow. But the difference between that payback period of uneven cash flow and discounted payback period is this. The payback period of uneven cash flow makes use of cash flow. Okay, it makes use of cash flow, the way the cash flow is given to you in the question, future value cash flow. But when you are calculating your discounted payback period, you are not just making use of your cash flow, you are making use of your present value cash flow. That is why look at the cash flows given to you in the question. Okay, you are going to invest 3,750. Then every year you'll be receiving 1,400. Look at it here, 1,400 every year as your revenue, or let us say as your contribution. So they have to discount it by the discount rate of 9%. Okay, these are the discount factor, and they got this present value. So it is this present value that we'll now be doing the cumulative, isn't it? We'll now be doing our cumulative what? Present value. And how do we go about our cumulative present value? Just put your 3750, put it back. So you have gotten 1284, it will reduce it. So 3750 minus 1284, you get what? Minus 2466. You got back 1180, it's going to reduce your 2466 to what? 1286. You got back 1080, it has reduced it to what? 206. And finally, when you received 991, it reduced it to what? 785. It therefore means that our discounted payback period is what? 3 years. Ignore the first year, which is year 0, as I've always said. Ignore this year. So let's go year 1, year 2, and year 3. These are the 3 years that have negative values. So you say 3 years. And what? 206, Abby, divided by what? 991. 991. So you can now multiply by 12 months if you want your answer to be in 12 months. So this is the 206. You're going to divide it by what? The 991. Because this 206 is the last negative. So pick the last negative figure, okay, and divide it by the what? By the next what? Present value that comes into the analysis there. And that is how you get this. Okay, and that is how you get this. So your discounted payback period is not far from your normal payback period that has uneven cash flow. The difference is that you are making use of your what? Present values, not like your uneven, that you are making use of your future value cash flows. So this is all about sensitivity. It is not more than this. The other thing that IGA can set in your sensitivity is this part. They will tell you to state the strengths and the weaknesses of sensitivity analysis. So that one, go and read it. Okay, the strengths and the weaknesses of sensitivity analysis. I guess in this question you were also asked. Okay, you were not asked. I think there's one other question that you were asked. So they will ask you to state the strengths and the weaknesses of sensitivity analysis, and that is all. So having understood this, let's go and solve the sensitivity analysis question that we have under Tinko Limited. Please stay with me. You don't want to miss out. All right, so what did they say we should solve here? So A, can I do that here? Let me do that here. So let's do that here. The B, sensitivity analysis. So the first one that they want us to calculate is the expected annual contribution, which is the same thing as your sales volume. Abi? The sales volume. So you want to calculate the sensitivity to the expected annual contribution. So I will just say sensitivity to contribution. Skill student, this was tested last diet on your number 1, so be careful. So this is MPV, all over what? The present value of what? Of your contribution. And since I told you that contribution is an inflow, Abi, what did I say you should do to inflows? It's going to be net of tax, Abi. You're going to deduct that from it. Please be careful with this. Okay, it's an inflow, so you have to deduct that from it. I hope that makes sense. So what's our MPV based on what we have solved? Who knows? I think 2854, Abby.
2853.
2853. Let's confirm. Okay, 2853. So let's go. 2853. 2853. Now, what is our present value of contribution? Now, that is where the problem is. That is where the problem is. Sabi that affected us here. Okay. We did not do contribution. We did not do contribution here in this table. But however, and there was a place we did contribution. I think our contribution was 6,000 naira.
Yes, sir.
Contribution is 6,000 naira. We're going to look for our present value of our contribution. So this is how you do it. Please look at it. It's very simple. So my contribution, I'm going to say yes. Watch me. I'm going to say yes. Okay, yes. And my cash flow, my discount factor at whatever percent, and my present value. The first thing I want to look for is my contribution. Okay. So my contribution is going to last for how many years? From year 1 to year 5, Abby. I have to look for my present value. It's going to be for year 1 to year 5. Then how much is my contribution? I think it's 6,000 naira. Isn't it? Good. Now, how much is my discount factor? Now, you may be thinking that discount factor is 15.5%. At least that was what was given to us. Please don't forget, 15.5% is your discount factor, but specifically your money discount factor, which is your money rate. But this 6,000 is a real rate. The 6,000 is a real rate. It's a what? It's a real cash flow. Don't forget, it's a real cash flow. So it therefore means that two things are involved. Either you increase this 6,000 to money cash flow, or just change your 15.5%, which is a money rate of return, to real rate of return. So this rate, that's what I'm going to be doing. I'm going to be changing this 15.5%, which is money rate of return, to real rate of return for me to discount this 6,000. And that is what I'm going to be doing here. Is everything correct? Are we good? Okay. Since we are good, once we get our contribution, we said our contribution is net of tax. So we're going to put in our tax. Now, our tax is also going to be paid for how long? It's going to be paid from year 2 to year 6. Come and flow with me. Our tax is delayed for 1 year, Abi? So if you check our taxes here, okay, we have year 2, year 3, year 4, year 5, and year 6. So our tax is going to be for 5 years, but starting from year 2 and ending in year 6. But our contribution will start from year 1. You know, this cash profit contribution is inside. It started from year 1 and end in year 5. So let's go year 2 to 6. Year 2 to 6. Please, how much is our tax? How much is our tax? What cash flow are we attaching to our tax?
882.
Our tax on contribution. Tax on contribution. Not... Good.
20% is the rate.
Okay. So our tax, listen, our tax on contribution, watch me. This part is very interesting. Our tax on contribution will now be how many percent? 20% of how much? How much is our contribution? 6,000. That will give us how much, please?
12.
12. Now, this is where I want you. If you are distracted, please listen to me. Textbook did not explain what I want to tell you here now. It's very important. Please watch me. Now, this one too. Is it real cash flow or money cash flow?
It should be real cash flow since it was the 20% was applied on the real cash of 6,000 naira.
Okay, thank you for that. Any other suggestion? Any support? Any arguments? Or are we good to go? Patience, help us.
So what he said was like almost the same thing I wanted to say.
Okay.
Well, let me say this now. Let's see.
Okay. What about if I disagree with what he said? Do you have a change of mind?
Based on what we've done so far and what we've been doing so far, it's real cash flow, sir.
All right. Now, based on what we have been doing so far, yes, real cash flow, because we have been using inflation rates, 5%, 5%, 5%. So it is inflation rate, real cash flow. Now, get this and let it sink. Very, very important and strategic. This 20% tax rate you are seeing here is money tax rates. This 6,000 you are seeing here is real cash flow. I'll come back. The tax rate given to you in an MPV question, that tax rate, all things being equal, what am I saying? All constant, everything void constant, it's money rates. Because 20% is going to be your tax in year 1, it's going to be your tax in year 2, it's going to be your tax in year 3, it's going to be your tax in year 4. It hardly changes. Your 30% tax rate that we have been using, we've used it for so many years before they now came up with the idea of small company, medium company, and large company. So tax rate does not really change. So in an MPV question, the tax rate given to you are usually money tax rates. Money tax rates. What we have been doing since was inflation 5%. That's why you will not say, oh, it is real cash flow. This one now is tax on the perspective of tax. This rate given to you is your money tax rate. Applying a money tax rate on 6,000 naira, which is a real cash flow, produces a money cash flow of 1.2. Am I making sense? Am I making sense?
Yes, sir. Yes, sir.
Please, can somebody talk to me? Are we together? Are we together? CY Blaze, are you with us? Chamaka is silent today. Where is lecture?
I'm not with you.
Boss, that simply means the 1.2 is money cash flow, while 4,800 is the real cash flow out of that 6,000.
Okay, I'm coming to what you just said. Is lecturer with us? Is barrister here?
It's you.
Are you with me?
Yes, sir.
Now, there's no big deal. There's no big deal. Many of us have been practicing as an accountant for many years. Let's go back to when we were practicing as an accountant. Forget the new tax law and the Finance Act. When you started practicing as an accountant, let's say far back as 2010, what was your tax rate? If you can remember, many years ago, it was 20%. Later, it entered 25. Later, it became 30. Many of us, we met 30. Okay, many of you that started accounting career, you met 30. Ask yourself, was that 30, was it changing every year? Is it that this year to be 30, next year to be 31, another year to be 25? No, it was fixed for years. The tax reform you are seeing, the last time tax reform took place was in 2011. That was when Peter had tax reform. 2011. So calculate 2011 till when the new Finance Act came, Finance Act 2020. Do you know how many years? And since then, we have been paying taxes of 30%. Am I making sense now? 30%. So what we are trying to say here is that your tax rate is not a real, it's not just for today. It applies to the future. Even if that project will take 5 years, it will shock you that that tax rate will apply to the next 5 years. So the way we look at tax rate is that we look at tax rate as a money tax rate, not as a real tax rate. But this your 6,000, no doubt, your 6,000 is today real cash flow. So we want to see what is the portion of this 6,000 that is tax. That was why we said 20% of 6,000. And that is how we got 1,200. So my question is, this 1,200, does it represent real cash flow or does it represent money cash flow? Well, you all said real cash flow. I don't blame you for saying real cash flow. But professionally, I am telling you that this 1,200 represents money cash flow because it was multiplied by a money tax rate. Am I making sense now? Am I making sense now?
Yes, boss.
Good. I'll give you further explanation. The same thing happens to depreciation. When they say that your asset will depreciate by 5%, by 10%, by 15%, ladies and gentlemen, that particular percent, all things being equal, if they like, let them not say anything at all in that question. That particular percentage is a money depreciation rate. Because you will not tell me that you're going to use 25% this year, you will not use 30% next year, you will not use 27% next 3 years. It doesn't work that way in accounting. So in the next 5 years, till the asset finishes, till the asset has no other value, that 25% I was giving to you in the question, that's what you are going to use going forward. So if you multiply that 25% by any amount, what you are getting is your money cash flow directly. Does that one also make sense?
Yes, what?
Makes sense, Abi. So that's good.
Yeah.
So thank you. So that means that your 1,200 is your money cash flow. One more for us to do. I haven't understood this. Now, since we understand that the 1,200 is your money cash flow, the next thing for us to do is to discount it by 1 year. Okay? Is to discount it by 1 year. Or let's say to remove 1 year inflation from it. That's what it means. Okay? Now, the reason, please listen, this is very important. It took time, okay, to get these things when you're studying your ICANN pass question. Now, I'm going to remove 1 year inflation from this. Or let's say better still, I would discount by 1 year. Now, this is not really a golden rule that you must discount by 1 year or you must remove inflation by 1 year. I may remove inflation for 2 years. I may discount for 2 years. It all depends on how the question comes. Now, because the question says that taxes are delayed for 1 year, it therefore means that this 1,200 will be delayed for 1 year. Okay? We are supposed to pay this 1,200 this year, Abi, but we'll pay it what? For next year. So we have delayed it. We have delayed the payment. Instead of us to pay it this year, we are paying it for what? For next year. So we are delaying what? The payment. Therefore, we are removing 1 year inflation. Okay. Let's put it this way. Let's put it this way for simple understanding. Let's say we have 3 years in a project, right? We have 3 years. So our tax on, let's say our contribution, take an example, our contribution is how much? 6,000. So let's say in year 2, we only have figure for year 2. And our tax is how much now? 1,200, Abi. Let's assume, right? Let's assume. Okay, our tax is 1,200. Now, I can't put 1,200 here. First and foremost, this one is real cash flow. It therefore means that if I'm putting any tax figure here, that tax figure must be real cash flow. So I can't put 1,200 here because 1,200 is a money cash flow. Okay, you get it now. So I need to convert 1,200 to real cash flow. And the only way I can do that is to remove 5% inflation. I'm only going to remove 1 year from it. The reason for the 1 year is because taxes are delayed for 1 year. If it is 2 years, if they say that the tax of 2020 will be in 2022, that means that you will jump to 2021 and go to 2022. I'm going to remove 2 years working inflation from it. Does that make sense? So this 1, 2 that both of us have got it, which is a money cash flow, I can't just take this 1, 2 and slot it in here. It is a taboo. It's a financial mistake because your 6,000 is real cash flow in contribution terms. Why? This 1, 2 is money cash flow, which is wrong. So financially speaking, I have to remove the inflation that is making this thing to be money cash flow. When I remove the inflation, it will what? It will downgrade this figure to real cash flow rather than the money cash flow. Am I making sense, please? Together, please.
Yes, we are.
Very interesting. Now, if we are, it therefore means that our 1,200, discount it for me. 1 all over what? 1 plus R, Abi, is for N. You are discounting it, that means you are removing. It's not like you are increasing. When you are increasing, you would have said 1,200 into bracket 1 plus what? The rate, Abi, is for N. This is when you are increasing. But when you are discounting, you are removing. You have to use your discounting factor. So what would this be? 1,200, Abi. 1 all over 0 plus. Please, this rate will be your inflation rate, not your discount rate. Your inflation rate is 5%, so that will be 0.05. Am I good? And you are only discounting for 1 year, so this is power 1. So give me figure for this, and that it should be lower than 1, 2, because you are discounting. What do you get, please? What do you get, please?
1,143. I approximated it. 1,143.
You are blessed.
Although it's
1,142.
1,142.85. Yes, 1,142.85.
1,143. Ladies and gentlemen, are you with me? Are you angry with me? Are you angry with the question? Or are you angry with item? Can we proceed?
All of the above.
All of the, I'm included. I'm trying to make life easy for you. You're angry with me. Okay, so that is that. That is that. You see, and that is the technicality with this. You know, somebody that was doing PM would think that he has seen all about investment appraisal, not knowing that there's something known as FM, where investment appraisal is taken to another level. Do you understand? It's taken to another level entirely. So that is why sometimes you don't boast of what you know, because you don't even know what other people know. So when you are in skills, you think like you are the almighty. So welcome to professional, welcome to FM, where investment appraisal is now another thing else. So that is what we have to do for this. So just multiply from, okay, how do we get our discount factor? Our discount factor. Now, all these figures are in real terms. Now, it's therefore wise that our discount factor must be in real terms. What was given to us is 15.5%, which is in money term. So therefore, we have to convert the 15.5 real discount factor. You want to stay with me, right? So that will mean that my money discount factor is equals to 15.5%. But what about my real discount factor? That's what I need. I don't really know it. But because I know that I have a formula known as the Fisher's equation, which will help me to convert anything, anytime, what am I going to do? My real rate or my real discount factor is going to be equal to 1 plus the money, okay, all over 1 plus the inflation minus 1. You know, when we're looking at the money rate, we said that the formula is 1 plus the real rate, Abi. And we said 1 plus the inflation. And we said minus 1. So this is when you're looking for the money rate, and this is when you're looking for the real rate. Am I making sense? Am I making sense now? So let's look for the money rates. So what is 1 plus? What's our money rate? Can somebody do 15.5? Give us 0.155, Abi. Check out. Divided by 1.
Yeah, 0.15.
The inflation is the inflation is 5%, Abi. That will be 0.05, Abi. Then minus 1. So that will be our real rate is equals to 1.155. Okay. So 1 point, sorry, please. So 1.155, Abi. So you divide it by what? 1.05. Then you say minus 1. Can somebody run it for me, please? Final answer.
.1.
That's 10%. 0.1 times 100, that's 10%. So our real rates will now be 10%. Okay, it's usually lower than your money rate, so there's no big deal. So that is to say, we're going to be discounting these old guys. Where are you? Where are you? With 10%. Okay, a minute, please. Does anybody have the, what do you guys call it?
Annuity table.
Yes. Pilot 2. Let me see if I have it here. Okay. Hold on, let me check here if I have it. It will be given to you in your exam, so no checking. We can actually use formulas to do these things, but don't think it's here. Hold on. After the question, it should be. Okay, let me check the other one. Hold on, please. Pilot set 1. Hold on. But if you have, you can help us, so we'll not waste time. I just want to be sure that everybody will be on the same page. I used to have it on pilot now, on this pilot. Did I remove it? Or did I remove it? I really need it though. Does anybody have the annuity table?
Yes, yes.
Oh, this is bad.
Yes, I do.
Okay, a minute. Let me check this one more time. If you can't see it, then you help us. Okay. Okay, look for the annuity table 1 to 5 years. What's the discount rate? Cumulative, okay? One to 5 years. I'll be checking. Let me see if I have it. Okay, bad guys. All right. Yes, you have it. Figure now is hard.
3.791.
0. It's not possible now. It's an annuity.
I said 3.791.
Okay, correct. That should be correct. 3.791. Okay, for those of you that wants to check, they're checking at 10% for 5 years. Okay, 5 years. What you do is to say 10% here. Please ensure that you are using the annuity table. Very important. 10% for 5 years. So trace it down. It's 5 years. That's just about 3.79. Okay, 3.79. So that's what we are using here. Now, please pay attention. This is where it gets very much interesting. Now, our tax is from the 2nd to the 6th year. So how do we get it? Anybody? We've done something like this before, so it's no big deal. In our last class. How do we get our tax, which is happening from the 2nd to the 6th year?
I think we'll do for 1 to 6, then do for 1, then subtract 1 from the 1 to 6.
You will live long.
Amen.
So 1 to 6. So let's do our annuity from year 1 to 6. So 10%, okay, for 6 years. These are our 6 years. So we'll get 4.35. Okay, so let's take that 4.35. Okay, then do for 1 year. You are doing for the highest and the lowest. That's what you are doing for. Then do for 1 year. What is 1 year? Look at 1 year. 10% for 1 year. 0.90. So let's go 0.90. So help me take it out. What do you have, please? Like minus, that's what it means.
$3.45.
Yes, 3.45. Okay, ladies and gentlemen, we are good. So just multiply them. 6,000 times 3.791, 3.45 times 1143. I think this is 3,009.
943.
Oh, yeah, do this last one for me.
22,746.
22. Help me add up. 746.
26,689.
No. You are not adding now. Sorry. This is tax. You are taking out.
Sorry, subtract.
Hmm. Yeah.
18,803.
18. 18,803. So 18,803, you take it. That is our present value, okay, of our contribution net of tax. That's what it means. So that's going to be, so you know, here we said 2853, which is this thing here. So then I say divided by 18,803. Quickly run it times 100. Or just divide times 100. What do you have?
15.2%.
15.2%. Who can interpret this? So I told you that when you are interpreting, okay, when you are interpreting, I mentioned something. I said when you are using outflow, you use the word rise or above. Abi?
So this is an inflow.
Yeah, this is an inflow. It's what? It's below, opposite now, below. You
It
know,
must not drop below 15.2%.
Exactly. So your contribution must not, you know, contribution is money coming in. So if your money coming in drops, no issue. But if it drops below 15.2%, Oga, your MPV will turn 0. Okay? Your MPV will turn what? 0. That is what this interpretation of what sensitivity to contribution actually means. Are we good? Any question, please?
Good, sir.
It's good, Abby. We are good, Abby.
Yes.
Okay. Then what is the next one?
I think they said that tax rate.
Okay. So that's the next one.
Yes, the tax rate.
Nice. Let's call it just B.
Sir,
Yes.
I didn't get what you said. You said if it drops, I didn't get it. The network.
Sensitivity to tax rate in minutes. I said when you are interpreting your sensitivity, if it's an inflow, you use the word rise and or above. Those are simple words you can use. If it's this outflow, sorry, then if it's an inflow, use the word below. It must not go below. Your money that you are receiving must not go below. My salary will not make you no drop past the one where they received before, unless poverty go home you or hunger go home you. That's what we're trying to say here. So if your contribution, your sensitivity to contribution is giving us 15.2%, the interpretation of your 15.2% simply means that your contribution can fall, but it must not fall below 15.2% unless the NPV will be negative. To affect the NPV, it's going to be negative. And once it's negative, what does it mean? You can't accept it again now. You can't accept it again. That's what it means. So let's look at our big boy, tax. Did I show you formula for tax here? Okay. If it's not there, it simply means it is present value all over what? NPV all over present value of tax. We already know what our NPV is. Who can remind me, please? 28 something, 2854. 53. So the only challenge that we're going to have is our present value of tax. Abi? Good. So let's solve for that. So our PV of tax is what? How much is our tax rate, please?
20%.
Okay. So what you're going to say 20% of, you know, we had a contribution of 6,000 and we had a fixed cost of 1.8. It's going to be 20% of what? Of our cash profits, which will be what? 4.2, Abi? Which is going to be what?
840.
840. That's how you run your tax, present value of tax. So it is 840. Because you can't go and pick all the taxes that you have done here. You can't just go and be picking all the taxes that you have done here. Look at tax. You have 882, 926, 972, 102, and 1072. No. We are working with the real cash flows. Abi? All these ones are future cash flow. So we're working with today's value. What is today's value? Today's value is saying that our contribution is 6,000. We did it somewhere here. Our contribution is 6,000, Abi, and our fixed cost, there's it. Our fixed cost is 1,800. Contribution is 6,000. Fixed cost is 1,800. It therefore means that our taxes are calculated on what? 4,200. And that's what we just did. And that 4,200, don't forget, is our today, year zero. And I'm making use of my real cash flow when I'm doing this computation. I'm making use of my real cash flow when I'm doing this. It makes me work easier. Okay, so it's 840. Now the question is this: 20% of 4,200. We know that this 4,200 is real cost is real cash flow. This 20%, what cash flow is this? What rate is this? Sorry.
Money tax rate.
Money tax rates. I'm impressed. Now, it therefore means that the result will now be what? Is it real or money?
Money.
Money cash flow. Okay? Good. Now, what is the rule guiding our tax in this question? There's a 1 year delay, isn't it, in tax? Yes or no?
Yes.
So since
Yes.
there's a 1 year delay, this 840 that is a money cash flow, how do I convert it to real cash flow, which is today terms? By removing what? Inflation of 5%, Abi, for 1 year.
Yes.
So how do I go about it? 840 times
840.
1 all over
1
1
over
plus 0.05, Abi, is for 1.
Yeah.
Give me my figure.
$800.
That's 800.
800.
800. Yes.
That'll give us 800. Are we there now? Good. So this is my 800 now, multiplied by my discount factor, because I'm looking for the present value. What we just did is to remove the inflation of 1 year, to multiply it by our discount factor. Which discount factor will I use? Don't forget that my taxes are going to be paid from year 2 to year 6, Abi.
Yes.
Good. So what is that discount factor that somebody gave to us from year 2 to year 6? This is it now. 3.45.
Yes.
3.45.
Abi?
Yes.
Yes. This was where we calculated it. Okay, so let's go down and finish the work. So times 3.45. That's our discount factor. So that will give us how much?
2,760.
2,760. All right, so that's our figure. Copy it and put it here. 2,760. So give me my figure, my answer in percentage. In percentage. Egone.
1,033. 1.033.
It's not in percent.
Yes, 1.033. Oh, okay, in percent. Sorry.
I'm getting 103.
103. Point what?
Yes. 0.4.
Yes, 103.4.
Any question? Any question? That is all. That is all. Any question? So you see, as simple as this question, or let us say as short as this question, you have a lot to do. But it's quite simple. Practice makes perfect, right? It's just quite simple. So who can interpret this rate for me?
tax must not rise above or be above this 103.4%.
It's as simple as that. Your tax must not rise with what? Above 103.4%. Because that's an outflow, I mean.
I didn't get you.
Tax is an outflow now. Outflow.
Yes, sir. Yes, sir. Yes, sir.
Not rise above. If it rise above it, too much money will be going out in form of tax. Your NPV can turn to what? Negative. And that is what it means. Okay?
Okay, sir. So, but sir, if it was inflow, it must not go below 103.4, right?
Exactly. Exactly. Are you with us? Are you with me, please?
Yes, sir. Yes, sir.
Your assignment is going to be the B. Okay, your assignment is going to be the B. However, I have one more class, right? I have one more class to address the normal investment appraiser. In that one more class, what I'll be taking you is relevant costing, and investment appraiser. I plan taking both today, but I see it's not possible. Okay, so what I took today is investment appraiser and what? Sensitivity analysis. Okay, sensitivity analysis. Does that make sense? So in my next class with you, I'll take a solid question on relevant costing and investment appraiser. Then after that, I can now start moving to capital rationing, maybe lease and the likes. We'll just take some questions there round up. And that will be that. Any question on this before we call it a day or a night? Any of them?
Please,
Any
boss.
question?
Please try to drop.
Okay.
Are you with me, sir?
Yes, I'm with you.
Please try to drop the video tonight, sir, for over 25 minutes. It was just logging me out, in. So I want to go through it, please.
Can we do it tomorrow morning, please?
Okay, sir. Okay, if you wish.
I'll drop it tomorrow.
Thank you.
All right. Okay, going to the video will help you because most of the techniques that I used here are the ways that your SFM question on investment appraisal would come. Okay, and as I've said, two things about to happen this May diet. ECAN should test either investment appraiser or M&A. That's your number one. So please hold it tight. Hold it very tight. Hold it very, very tight.
Sorry, sir, what's the second thing you said after investment appraisal?
M&A, mergers and acquisition. Okay, that's our professional level anyways. Investment appraisal was tested last night at skills level. So we'll know what will come out these diets. But anyways, investment appraisal has different methodology. They can repeat it for 3 diets without any of them looking alike. So you can never tell. Ladies and gentlemen, I remain Dr. President. Thank you for your time. Thank you for staying with me.